Welcome to Hedge Fund Tips with Tom Hayes for the week ending September 25th, 2020. I'd like to welcome everybody. This is our 49th VideoCast and 39th podcast. So we're going to get right to it. We've got a ton to cover. And as always, we're going to start with our media spots where we cover a lot of information in a short period of time. First, I'd like to thank Ellie Terrett and Liz Klayman for having me on yesterday on the Klayman Countdown on Fox Business. And the question posed to me, Liz asked, if there is no stimulus deal and consumer spending goes down, there was a note out by Goldman Sachs saying that they were taking down their Q4 estimates because they no longer expected stimulus. What stocks should you buy if consumer spending is going to be weak? So what will they have to spend money on? And what I pointed out was, and by the way, you can watch any of these clips. You just go to hedgefundtips.com, click on this featured on button on the top of the website. It'll come right up, and then there is a video you can watch right there. You just click on that for the YouTube video and get more detail. So the part of this note was, yes, the Q4 estimates would come down, but the second part was there will be a catch-up trade. So while they're expecting negative 3.5% GDP with no stimulus in 2020, which, by the way, is up dramatically from just a couple of months ago. You had the IMF, I think we were kind of poking fun at it a little bit in June, saying U.S. was going to be down 9% in 2020. So now we're at negative 3.5, but the rebound catch-up puts us at 6%, which we've been talking about for months now for 2021 based on the increase in money supply. To answer Liz's question, we went into dividend growers. So consumers would still have to buy electricity. We like Con Ed. Con Ed was down 21% off its recent high. It yields 4.17%. It's increased its dividend every single year for the last 46 years. They would have to buy drugs, so they pick them up at Walgreens Boots Alliance. That one's off 43% from its recent peak. It yields 5.3%, and they've increased their dividend every single year for 44 years. And then for medical supplies and devices, you could be in Becton Dickinson. That's off 22% from its recent highs. It yields 1.4%, and they've increased the dividend for 47 years. And then Soup and Snacks, Campbell's is down 17.5% off its recent high and yields 3.1%. Why is this important? This came up as a question from a reporter earlier this week, which the article's not out yet, so I'm not going to spend a lot of time on it. But where do you find income in a low-rate environment? And we're going to talk about that a little bit in the article. So these stocks fit the bill: Con Ed, Walgreens, Becton Dickinson, Campbell's. These aren't recommendations. See terms. You have to do your own homework, talk with your own financial advisor. But it's stocks that would hold up in that type of environment. Now, we're going to talk about some things here and some breakthroughs that I see coming in terms of stimulus. And for those who've been listening in, I've been pretty pessimistic about that for the last 4 weeks, about them getting a deal done before the election, and that's proved to be true to date. But let's I think the administration now has some leverage that may force some hands to get something done, and we'll talk about that. The other thing I covered with Liz was that the reopening trade is working in the month of September. That's another theme we've been pounding on for weeks. And it really began in earnest in September with industrials, materials, transports, and financials all outperformed tech so far this month. That's new. And the market is really just looking to fill an information vacuum. It needs clarity, and that's why we've had the choppiness. It needs clarity on the vaccine, which we're going to talk about, earnings coming up in just the next few weeks, the election, and the stimulus, which we're going to talk about. So I want to thank again Liz Klayman and Ellie Terrett for having me on Fox Business, the Klayman Countdown, yesterday. Moving on to CGTN Global Business, I want to thank Rochelle Akufo and Stephanie Savage for having me on last night to discuss the China recovery, and particularly China foreign direct investment. And the reason we spend a lot of time on China, for those of you who are new that are joining us, is because their cases peaked about 2 months before ours. in our epicenters. Their epicenter was Wuhan. Our epicenter was New York, New Jersey, Connecticut. So our recovery trajectories have followed theirs, the roadmap, with a 2 to 3 month lag. So by seeing what's happening to them, we can kind of get a glimpse into the future of what's happened to us. And so far, that's proven to be very accurate. Foreign direct investment into China increased 2.6% in August. That was up from a negative 10.8% trough in March. So big recovery there. However, U.S. and China bilateral FDI is at a 9-year low. That's attributable to bilateral security concerns. Obviously, COVID is a major factor. Trade tensions, although the phase 1 trade deal is going better than expected, the ag purchases are better than expected. They're in line with the commitments of the trade deal, and that's in part due to they had flooding that obliterated some of their crop production and their ability to transport, as well as they had the swine flu with their pigs that culled 1 million pigs from their herd. Pork is 60% of their diet, so we're getting a lot of exports on the ag front. That's also a major source of our foreign direct investment into China. It represents 26%, followed by entertainment and energy. The other aspect, China implemented capital controls after the 2016 peak. They had invested $46 billion. A lot of it was coming into New York City real estate, I remember. And after that, it's when they instituted the capital controls, that affected China's direct investment into the U.S. And then finally is the bilateral political pressure that I discussed with Rochelle between TikTok, WeChat, Huawei, NYSE listings, and then China coming out this weekend with the unreliable entities list. So it's just been a back and forth, but business leaders are obviously on both sides wanting the government to find a way to work things out, because businesses have generally benefited from bilateral trade, and I think it's just going to be a push-pull working together on that front. The thing that China's done in terms of their recovery that I noted, because it's very important of what we need to do here in the U.S., is their credit growth. They've done $187 billion of new loans in the month of August, up 29% from the month of July. And I think basically regulators in the U.S. really still have the handcuffs on the banks. You know, they're fighting yesterday's battle, and what they need to do is focus on today's battle, which is a recovery, and really take the handcuffs off and let these banks lend. I'm speaking, obviously, my book in the case of Wells Fargo. They need to remove that asset cap. They've cleaned up their mess over the last 2 years since the asset cap came on. They've cleaned house with management. They've changed their policies. You can't handicap the one of the top lenders in the country and expect a sustainable recovery. China knows that. They're having massive credit growth, which is why their GDP is now expected to grow 2.3% in 2020. And 7% in 2021. We're going to grow 6% in 2021, but we could probably grow 7 or 8% if we just let our banks do what they do best and get on with it. So that is a good lesson and an opportunity for us to take advantage of. Obviously, they've done 3.6% deficit spending, which historically they've never gone over the red line of 3% deficit spending. That's helped them. Lowered rates, we've done that. Tax exemptions have helped them. But just to give you some idea of where we're headed and why this interview mattered to the U.S. listener, is their shopping malls are now reopened. Their consumer got a positive print last month for the first time since COVID, which is huge, both for them domestically, but for the world, because, you know, their recovery had been driven by government stimulus. They did $500 billion in the month of May, the deficit spending, as I mentioned, but that went into industrial, railroads, power lines, electric charging stations, etc. And the consumer wasn't quite catching up. And I said in a month ago, I think I was on with Rochelle, I said, the consumer is lagging. You know, you'll see the industrial, you'll see the construction first, and the consumer will catch up. Well, boy, did they ever. You got that positive print. Malls are now reopened. 80% of their movie theaters are open. Unemployment's now at 5.8%. Their residential property sales were the highest since 2017. We're getting the lagged effect. We're going to talk about some of the data in the U.S. is just knocking the cover off the ball. Their discretionary retail car sales are up 11.8%. Mobile phone sales up 19%. This is all in the month of August. And their freight volume, that's very important, was up 7.3%. Domestic air travel we've talked about, and you got to look through my glasses here. I know you guys are skeptical, but they're at 86% of pre-pandemic levels in terms of their domestic travel. We only got to 40% so far, but again, we're 3 months behind them. That's number one. Number two, we have these 14-day quarantines, which make absolutely no sense. I flew, I guess now it's a month ago, and I had to sit at home for 14 days and report to the government that I flew, which makes absolutely no sense. Because if masks work, then, which I think I'm of the camp that I think they're helpful, then why would you ever have a quarantine? It makes absolutely no sense just because I flew and helped the economy and, made things happen. I'm going to wear a mask whenever I'm out in public, in indoor places, etc. There's no reason to have a 14-day quarantine. Once that's lifted and people can travel, everyone wears masks on the plane and in the airports. It's totally safe. You're going to see these numbers just crush it. Maybe they'll get the memo and implement this right away. And then by November, December, in time for the holidays, you could really see travel skyrocket. Maybe we get 60, 70%. I mean, that's awfully ambitious, but with masks and removing the quarantine, because most people can't come back from a vacation and then sit in their house for 2 months. They got to get back to work. They got things to do, take the kids to school. So just get rid of that quarantine. People will wear masks in public. They get it now. And that's that. So that was it with Rochelle Akufo and Stephanie Savage. Thanks again for having me on CGTN Global Business. Okay, next we're moving on to... Today I was in an article on Bloomberg. I want to thank Ruth Carson and Masaki Kondo asking me about the dollar. The dollar is bottomed, and we're going to cover that in the short term. We're going to cover that in the article of the week, but the quote was the dollar. Okay, the dollar is the safe haven of choice until we get new information on the vaccine, until we get new information on the vaccine, earnings, election, and stimulus, said Tom Hayes, chairman of Great Hill Capital. Until then, the dollar is likely to have bottomed in the short term. So that's true. So we've been in this chop in the market, on days that you have shutdowns in the UK like you had or more restrictions in the UK like you had on Monday. Tech was up, cyclicals down, then you get vaccines, cyclicals come back, and that's just going to be the push-pull. Market's going to chop, and some froth has come out of tech in a meaningful way in the last few weeks, which we were ahead of the curve on that for those of you who've been with me for a while. Next, just thank you to Ruth Carson and Masaki Kondo for including me in Bloomberg. And finally, in Reuters, Devik Jain and Sagarika Jasingani, thank you so much for including me in your article earlier in the week on Wednesday. And basically, I was just going through that push-pull that we just covered. When the Dow outperforms the NASDAQ, it's telling you the market believes the reopening and vaccines are on track, and that's going to help large industrial stocks, said Tom Hayes, managing member of Great Hill Capital. And conversely, the other is true. When you see shutdowns and restrictions, then tech starts to get the flows or the stay-at-home stocks. So it's the reopening trade versus the stay-at-home and that chronic push-pull. But the trend is toward, as every day passes and we get closer to the vaccine, value cyclicals are going to start to take the lead in terms of relative outperformance. Again, to reiterate, this does not mean zero sum, like only energy stocks will perform and tech will not. That's ridiculous. Or only banks. It's just going to be what is historically the case in early parts of a news cycle when GDP growth is the fastest off a very low base. The cyclicals outperform. Why? Because managers have more companies that they can choose from in a fast economic growth environment that have earnings growth, whereas in a slow slow economic growth environment, slow GDP growth environment. They can only choose from a handful of sectors and subsectors, namely tech, where they can find growth. Once the economy's humming, they have many sectors they can choose from and many opportunities coming off the bottom. So thanks again to Devik Jain and Sagarika Jaisinghani. Thanks so much. Okay, this is the key thing. I'm going to start with the dessert, and then we'll get to the meal first, because on September, I think this article was from September, it's not dated. September 9th, this article came out, and it basically was President Trump was doing a press conference. And at a White House news I'm quoting now. At a White House news conference on Friday, Trump floated redeploying $300 billion in unspent funds in an account approved by Congress through the CARES Act. The president was referring to the Economic Stabilization Fund created by Congress in March, which was intended to be loaned to distressed businesses, but much of which has not yet been dispersed, according to two people who spoke on the condition of anonymity to discuss private conversations. Trump suggested he may be able to use the money without authorization, but stressed his preference is to have Congress sign off on moving the funding to other purposes. We have $300 billion in an account that we didn't use, and we're willing to use that, Trump said. I think there is a theory that I could do it without having to go back to Congress, but I think it would be appropriate to go back, and I would ask Congress to approve it. So, this was, about 16 days ago. This is the Washington Post that's quoting that. And I didn't think much about it. What he did last month with the executive order when they couldn't get a stimulus package, I can't believe they couldn't get something done. Well, I can believe it, but to at least extend the enhanced unemployment benefits for millions of people that were affected through no fault of their own, got furloughed or laid off from their jobs because the business is shut, because the world shut down for 2 or 3 months. I mean, the government shut down their livelihood. The government has to make them whole, and they couldn't come to a deal. And the administration just said, we're going to do whatever it takes. And we talked about it. Actually, ironically, it was on a Friday, and we said, I wouldn't be surprised if we see an executive order, and then, just issue the executive order and fight it out in court and get the aid to the people who need it the most. And I think it's getting at that point now. I know there were some rumblings that Pelosi's now willing to talk. Speaker of the House, Nancy Pelosi, is willing to talk again, and she's willing to bring down her offer from, $3 trillion to $2.5 trillion. I think that sounds my recollection was a couple weeks ago she was at $1 trillion and the Republicans were at $500 billion. So now she's willing to negotiate by taking her offer up. It sounds to me like nothing's going to get done. Now, sometimes when Congress's 401k plans are impacted, as they were in the month of September, probably being overweight tech, they get more willing to move, number one. Number two, they may be getting pushback, as we discussed last week, going back to their constituencies and saying, I did nothing for you other than shut your business down, put you out of work, and not make you whole. Vote for me. And that goes on the Republican side, and that goes on the Democratic side. That's not a partisan thing. They're not getting anything done. So I think the conditions are set up that it's now in the administration's interest, rather than wait for these, people in Congress to not get anything done or pretend to get something done and not get anything done, and wait for the politics while millions of people, they're fiddling while these people are burning. I think will have public support. The administration will have immense public support from millions of people that have not recovered as businesses have slowly reopened, to do another executive order on this basis. Now, I'm not an attorney, but I think in seeing what happened in August, and by the way, both for the Republicans in Congress and for the Democrats in Congress not getting this done, keep in mind, if you want to get reelected, whether you're a Republican or you're a Democrat, Trump poll numbers inflected to the day he issued the executive order. You can go to election betting odds, look at the chart, look at the day he issued the executive order to help out those people that were left behind with enhanced unemployment benefits, and he went from it looked like a guaranteed blue sweep. That's what it looked like before he issued that executive order, and it turned around on a dime and completely put him back in the game overnight. So he knows. I'm sure his pollsters are telling him, although he acts on gut, probably more so than he acts on pollsters, which helped him in 2016, he knows this is a win. Because let's say he does it, the only ones that are going to say it's illegal are the opposing party. And the opposing party says, no, we're going to sue you to keep $300 billion from the people who need it the most in society. That would be political suicide. That would be career suicide. So if I were in that situation, whether as a Democrat or a Republican, I would do the executive order tomorrow. I'm not saying it's going to happen or anything like that, but I would do it, and I would let them sue to say it's illegal to be done, and worst case, it doesn't get done. But I can then at least make the case to the people that I did everything in my power to help those that were in greatest need, and the opposing party blocked me from you getting it. And then, when I say, please get me my vote, I'm not culpable for not delivering. Whereas the other party or the opposing party would have to make the case why it made sense to hold up the $300 billion that was already approved and already allocated. So I wouldn't, in the administration's shoes, given the millions of people that need help, I would not wait around for them to negotiate $3 trillion, which we don't need, potentially, or $2.5 trillion, which is probably not going to get done. It's probably just to delay the clock until November, December, when these people are, the enhanced unemployment is going to be running out. And you got $300 billion. That's more than enough. You can get PPP out there. You could potentially do a second stimulus package, a stimulus check, which would be probably smaller or to a lower income bracket, which is great. The people most affected. You could definitely do the enhanced unemployment to the end of the year with that amount of money. And just do it and let them sue you. And then you explain to the American people, I put out an executive order to pay you XYZ stimulus check to continue with enhanced unemployment benefits. This group of people has sued me to stop you from getting the money that was already approved, $300 billion that hasn't been used. I think it's a win-win. I think it's a win for the most vulnerable people. I think it's a win for the people who have the courage to do that. So now, why would I be bringing this up after a 16 days? Why is this relevant now? Well, it's relevant because they've been fiddling while these people are burning, number one. Number two, Powell and Mnuchin were on the Hill talking about $300 billion in unused aid and talking about Congress approving it. Now, if I'm the other party, I want to take credit for helping these people out. I don't want to let the administration go over the top and get another win when he got such a huge bump in the polls by doing it in August, and we were just sitting there twiddling our thumbs and completely got shell-shocked. I would want my signature all over this, and I would say, yeah, we're going to approve it. We don't, if we can't come to a $2.4 trillion deal, we've already approved $300 billion. Let's do this together, bipartisan. Everyone goes home and says, hey, look what we did for you. We got it done in Congress. The Democrats can go and get elected. The Republicans can go and get elected, and everyone wins. So that's called career security, which is, what Congress people are very interested in. So that's that. On the flip side, there's been it's like a legal opinion or article circulating in the hedge fund community. You can find it. It's scholarship.law.duke.edu. I'll post it in tomorrow's reads, actually. So if you go on hedgefundtips.com, every morning I put out, be in the know, 10 key reads for Saturday. I'll have it as one of the I'll put it as the first read. But basically, here's the first paragraph. Presidential spending discretion and congressional controls. On the basis of the Constitution and traditional legislative prerogatives, Congress lays claim to exclusive control over the purse. We all know that. Nevertheless, while it is up to Congress to appropriate funds, it is also true that the president and the executive branch enjoy considerable discretion as to how those funds are spent. Existing studies tell us how the president formulates the budget and how Congress acts on the budget requests he submits. Surprisingly, we know relatively little about how the money, once appropriated, is actually spent. A notable exception in this field is a work by Lucius Wilderding Jr., published 3 decades ago. The purpose of this article is to present a more contemporary account of executive spending discretion, to show its impact on public policy, and to point to some of the techniques and procedures used by Congress to preserve its power of the purse. Although the president's spending discretion may seem essentially a 20th century phenomenon resulting primarily from the Budget and Accounting Act of 1921, it has been a problem since George Washington's first administration. A number of early examples underscore the fact, and additional historical perspective and balance to this presentation. The material is organized under 7 main headings: lump sum appropriations, covert financing, transfers between classes, reprogramming, transfers in time, impoundment, and unauthorized commitments. Within those broad categories are smaller sections on such topics as contingency funds, military assistance, no-year money, accelerated procurement, and coercive deficiencies. A number of these categories overlap, resulting in certain arbitrariness in organization. So this goes on. So that's the theme. It goes on for 38 pages, showing all examples of history when the president was able to use his discretion to spend the money that was already allocated. So he has a lot of precedent to stand on here, and maybe some lawyers will email me, constitutional lawyers, and step in. But I think even if it's like 40-60, 60% of the people say no way, 40% of my advisors say, yeah, you could probably do it, I would just do it and let the opposition sue me and say, yeah, we want to keep $300 billion from the hands of the most at risk that lost their jobs to no fault of their own. Good luck with that position. It's career suicide. So I would not be surprised at all. I know they're going through this pretend thing that they're going to talk about doing 2.4 trillion, which isn't even needed. What's needed is the people who have to pay their rent, in 5 days. They need their enhanced unemployment, and they need a second stimulus check. And I think Mark Cuban was out talking about 2 checks a week for the next 2 months. I don't know. I don't think 300 billion would cover that. But I don't think we need a lot more than this 300 billion that's already allocated. I mean, if they come to some agreement, 1 trillion, 1.5 trillion, that's fine. Ultimately, it's going to get, inflated away by purchasing power. So adding 3 trillion of debt, you say, wow, the debt to GDP is going to be 120% like it was in 1948. But then the economy grows notionally, it'll be 25 trillion on a $30 trillion notional economy. But still, we don't need that much. We've already done 99% of what we need. This is the last bit for those people that just need a few more months until the vaccine's out, until businesses are reopened. And I think this could be a catalyst. And by the way, if I'm the opposition party now thinking, wait a second, he's going to do this and it's going to checkmate us again. And the last time he just rocketed in the polls after doing this, we should get ahead of it and do a $750 billion deal or a $100 billion deal with our signature on it versus giving him all the credit for helping everyone out. So it's something to keep in mind now that there's this leverage in place. Both parties have to be interested in getting something done. So either we see something like this come up very, very quickly, or the opposition sees that it's in their interest to get ahead of it and take credit themselves and do a $1.5 billion dollar deal. But either way, I think this is something that the market is no longer pricing in. I mean, obviously, the end of today, the market was up. People think maybe there's stimulus, it'll be a good thing. Great. But on balance with the performance of the market in September, the market has effectively discounted, and that's why you saw the note from when I was on Liz from Goldman. Their base case is no stimulus, and this, I think, could be a big surprise. So keep that in the back of your head. Moving on to my favorite subject, banks. Article in Financial Times this week I posted. This is from Bank of America. Brian Moynihan said, "We set our second quarter reserves with a set of scenarios, and it turned out that the actual data has been better. Charge-offs keep coming down, frankly, because of credit quality," said Bank of America Chief Brian Moynihan. Wells Fargo Chief Financial Officer John Shrewsbury noted that in commercial lending, we've actually seen some better realized outcomes than we imagined. Code for we've both over-reserved due to CECL, which we've been pounding the table on for the last 4 some odd weeks. So I think you're going to see a change. We got another upgrade on Wells Fargo this week, so that's like 4 now in the last 2.5 weeks. Sentiment has to change. There were so that's that, and then there was a guy at the end of this article, Eric Hageman, manages $35 billion. He has positions in JP Morgan, Citi, Wells Fargo. And he said, if there are reserve releases, that's what we're talking about here. Remember, all in, they've done 100, the top 4 banks have done $35 billion of reserves, I believe, in Q2 because of CECL. They had to take 100% relative to $5 billion same quarter last year. So they were over-reserved by 20 some odd $billion. That's all going to come back as income over time as we get through this. Certainly the additional $300 billion would help, or a $1 trillion package if they could come to the table. But basically what he says, if there are reserve releases, the earnings number these guys are going to put out are going to be huge. And that's what we're counting on. And that's been our base case for some time. So Baird was the company that put out, the shop that put out the bullish fresh pick. He put a price target on it of $35 or 50% appreciation. So that was nice to see. And then my favorite bank reporter, Carlton English over at Barron's, put out a note explaining that David George's upgrade over at Baird, too much opportunity at the Stagecoach to ignore. And he covered the points that we've been talking about for the last handful of weeks. Namely, they're one of the few number one, they're trading at the biggest discount to book. It's only happened 2 times in the last, in their career, in their history, 1992 and 2009. In both cases, it took months to recover back to book. Book right now is running about $40 a share, maybe just a little less. And, but he also said that they have something that the other banks don't, which is their efficiency ratio is terrible. And that speaks to Charlie Scharf talking about they're easily going to take out $10 billion of costs just from headcount. And their headcount is actually outside consultants. He said he's never seen anything in his career. They pay like consultants through the nose like he's never seen in any business. So I'm sure they took a lot of that out in the most recent quarter. We're going to find out in a couple of weeks at earnings. So that'll be a positive thing. And I think these 4 analysts in the last couple of weeks are getting ahead of the curve. They see it happening. They were at the conference, the Barclays conference last week, and that's that. So the $10 billion of cost cuts, George estimates that each $1 billion drop in expenses could add roughly 20 cents to earnings per share and improve the bank's efficiency ratio by 1.4 percentage points. For reference, Wells Fargo's efficiency ratio, a measure of the bank's expenses over revenue, is above 70%, while peers are in the high 50s. Executing on cost savings and exiting the Fed's asset cap, which we've been pounding the table on. Once that's lifted, if the bank regulators and the administration actually want to see a sustainable recovery, like we saw credit growth, you must have credit growth to have a sustainable recovery. They lift that cap to one of the largest lenders in the country, and we're going to just fly. And that would be a near-term huge catalyst. Some patience is required, but we believe the risk-reward looks very compelling for contrarian investors. That's my middle name, Tom Contrarian Investor Hayes. And that was that. So great note by Carlton, recapping that. And, okay, the other upgrade was last week, which we covered from Steven Chubak over at Wolf Research, and his price target was 34%. So you got two bold calls coming in. Dick Beauvais had one before that, and there was one other. Now, the other thing I want to cover, so the article of the week was called the Cobra Kai Sweep the Leg Stock Market and Sentiment Results. And it was called Cobra Kai. It's a remake on Netflix of the original movie from 1984 called The Karate Kid that starred Ralph Macchio and William Zabka. Ralph Macchio played Daniel LaRusso, and Johnny Lawrence played his nemesis. William Zabka played his nemesis, Johnny Lawrence. And in the original movie, there was a scene where Johnny's evil sensei instructs him to sweep the leg and show no mercy. And if you play the short video, it's only 30 seconds, you'll see that, Johnny just takes out Ralph Macchio, Danny LaRusso, like in one fell swoop, just completely knocks the stuffing out of him. And that's exactly what happened to Wells Fargo this week. It was a sweep the leg move. And I'm looking at this chart here that I put out on Wednesday night. The article goes out on Thursday morning. We had a similar sweep the leg as basically when they take out all the stops. In other words, the technical traders that rely exclusively on technicals, everyone knows what they're looking at. All the algos know what they're looking at. All their competitors know what they're looking at. So the way that you inflict pain is you take it past their pain point. And that's basically what we saw in midweek this week. So we saw that in May. Support after the crash was about 24 and change, 24.15. And they swept the leg mid-May down to $22, 7-8% below support. No one had, I'm sure they all had their stops right below 24. It goes $2 below. Even for the optimists, they were just crushed. And guess what happened in the next 29 days after they, quote, swept the leg, just like Johnny did to Daniel LaRusso in The Karate Kid. They took the stock up 51% over the next 29 days. So it went from $22 to $33 in the next 29 days. And then you had more concerns about COVID, and then it rolled back over. And it's basically been in this support point here around 24, where all the purchasing volume has been. For the last 7 months, this is volume by price on the left-hand side. And they swept it below that resistance. They swept the leg. And what was interesting is I got this tweet, and this, I took the person's handle off and name because, I'm flattered that they even follow my work. And it's not about criticism. It's to embody the sentiment was so palpable, the bearish, negative sentiment. You saw it if you watched TV from the talking heads, etc. Like, no one wants to touch Wells Fargo with a 10-foot pole. And so I put out a tweet that day because I saw, I think it was a block of like 6,000 contracts of December Wells call options came in. That's institutional size usually. And this person replied to that. I think Wells Fargo is a broken record as at now. One scandal after another. New CEO opening another can of worms. Irrespective of the valuations, executive behavior will be the major drag as observed. And, I respect that, and it's got to be tough. This is, when your leg gets swept and you get knocked on your butt, like you saw Daniel LaRusso in Karate Kid, and now in the remake, the remake, by the way, on Netflix is called Cobra Kai. It's a little cheesy. I like it. I like to unwind for a half hour at the end of each day. I think it's worthwhile. You're going to watch it. You're going to be like, wow, this guy's strange. But nonetheless, I like it. So always like the underdog story. So anyway, so I replied, that's what makes a market. And that is what makes a market. So we got swept out. That was like max pain. Let's hope. But here's what's happened since. So that leg got swept in May. You went up 51% over the next 29 days. The leg got swept here on Wednesday, And it's making that same pattern, this spike up, pull back, and then hopefully a rocket ship off. Spike up, pull back, and we'll see if we get follow through. But no one would anticipate. Everyone, all the guys were out with their little shiny lines saying, "Oh, this is a breakdown," and everything else. And no, we'll see what it is. No one can be 100% sure. All I know is you have to know what you own, and I will buy this all day long. If I ever get another opportunity in my lifetime to buy it at a 40% discount to book, I'll do it again in 20 years when we have the next crisis. But this is kind of one of those things where the margin of safety makes perfect sense. Now, you could say, well, you don't know what you don't know, all the real estate exposure, all the energy exposure. No, I do know what I know. I know that they took 100% of expected reserves due to CECL, and I know what their worst case scenario is. And what they've just told me a week ago, 3 months later, after they have more information, is it's much better than they anticipated. So that's what I know. And it's trading at a 40% discount to liquidation value. So that's a pretty good thing. So that was good news. And let's see if we get follow through. But that's that. For the accounts that didn't have full positions, we use that as an opportunity. We'll see if we get follow through. But basically, the stock's done nothing for 7 months. So if you thought you were cute buying it down a couple bucks, in the scheme of things, it's not going to matter. The key is going to be, does the thesis play out? And if the thesis plays out and we break through all of this resistance here, we've got blue skies up until the 40, 44, up until book, a premium to book. When it gets there, we don't know. But will it get there? I think unequivocally, we just don't know when. I think it's going to be sooner than most people anticipated, but that's my opinion. That's what you've tuned in for. Do your own research on that. So the other point I made was nothing changed from last week. This was Wednesday night when it was down 9.15% for the week. It still hadn't taken out this long-term support that goes back 12 years. This is where most of the stock was purchased. This is the area that I felt institutions were defending. And as such, again, there's no overhead resistance until you get to the low 40s. So if we do get a catalyst, whether it's the asset cap coming off, earnings, just a change in sentiment, money continues to be a little bit leaking out of tech. Where is it going to go? If you get any announcement with the vaccine, like the Bank of America Global Fund Manager survey this month, managers said more than inflation, the number one thing that would cause long rates to go up, yields to blow out, would be the announcement of a credible vaccine. You now got 4 in phase 3. We got more good announcements this week on the vaccine front. You get that announcement, you're going to see the 10-year yield probably go over a point. It's at 65 basis points right now. I think you could see it within 2 months of an announcement being at 125. And then you got, the spread between effectively 0 and 125 would be the widest NIM that they've seen in years. And that would come off of one announcement even before you have inflation, which comes down the road. So this was defended, the Adx Crossover, which, I never even use it, but I just thought it was interesting. Anytime I find something that's 15 out of 16 of the last times it's crossed, you get these rallies consistently. I thought that was helpful, and nothing's changed on that front, and now it's much better. When this was taken, it was down to $22.83. I think it closed at, $23.60, so it was up $1.50 from there. So moving in the right direction. So that's that. And then the theme of the article has been Karate Kid and now the Cobra Kai, which is 20 years later when they're adults. But Mr. Miyagi used to tell Daniel, Daniel would get anxious. He'd say, I'm waxing your car, I'm painting your fence, I'm painting your house. You're not teaching me karate, you're just using me. And he goes, patience, Daniel-san. And then he would say, wax on, wax off. And he'd say, look, you have learned karate. And obviously from all the hard work, Daniel didn't know what it was leading up to. And what it was leading up to was a huge victory. Even though he got his leg swept in the end, he wound up with the crane kick and completely destroyed Johnny, his nemesis, by being patient, by putting in the time, putting in the patience, and ultimately winning in a major way. And we're hopeful that that's the outcome with this as well. So patience, Danielson. We remind ourselves that with this stock, which is one position in a very large portfolio, but a large size position, and we're excited for it. So let's see. Next, we pointed out that the cyclicals are beginning their move. We saw in last week's Bank of America Global Fund Manager Survey, obviously the managers finally got the memo that tech was most overvalued. It was the highest percentage of managers that managed 600 billion saying that they felt tech was in a bubble. They started moving out of tech and healthcare growth areas into value small caps and industrials. And that's evidence even till today, which is 2 weeks later, that we'll go back to Apple, Wells Fargo in a second. Industrials, financials, materials, and transports, all cyclicals have outperformed tech in the first 25 days of this month. So that's a very positive thing. Even the most loved stock in the S&P 500, which we talked about on September 1st before it crashed, relative to the most hated stock in the S&P 500, Wells Fargo, that inflection, which you can go back to our August 27th and our September 1st articles, which talked about how Apple, when Apple was, I guess, gosh, what was it at the time? $465. Anyway, it was literally to the day, which is more lucky than good. I was on with Brad Smith on Cheddar and Greta Wall on One American News Network saying that Apple is trading at 39 times current year earnings. The highest multiple it's traded at in the last 15 years was 26 times current year earnings. It was trading at 33 times forward. And I was saying it's time to lighten up on tech and to get into cyclicals. And I also talked about Wells Fargo trading at a discount to book. It's only happened 2 times. They can take $10 billion of costs out, et cetera, et cetera, et cetera. And Cecil. I went into a very long discussion on Cecil and how that's different and how it underreported the bank's earnings powers relative to the same period last year. It was underreported by about $23 billion if you did apples to apples due to a paper accounting change, not a $23 billion erosion in the underlying business. It was just the way that they had to account for expectations. So you know, that spooked people because they didn't know how to interpret it, but they'll get used to it now and they'll start to model it to either model the old numbers to the new standard or model the new numbers to the old standard so they can compare apples to apples versus thinking that the world is ending. So we got the huge outperformance of Wells Fargo relative to Apple this month, largely from Apple collapsing 25% peak to trough intraday, then Wells Fargo appreciating. So Wells Fargo took a break in the last few days, but the trend is still up. It broke the downtrend line on relative performance. Usually, sometimes they'll go back to retest. It looks like maybe not that extreme as it retested here already, and maybe we could continue this new upward trend. That's a good news. So here are the 2 articles I referenced: the Run DMC It's Tricky stock market and the Stevie Wonder Faith stock market, and you can click there. And that's where I go into the fundamental story, both on Wells Fargo and Apple as well. So moving along, this is also consistent with 2020 earnings estimates. So it's not just, hope that you're going to get a rotation. The numbers are proving that out. Energy, industrials, consumer discretionary, financials, and material will all outperform the earnings growth of the S&P in 2021. According to consensus estimates, the S&P is going to grow at 26%, industrials 87%, financials 31%, materials 29%, discretionary 76%, whereas tech is going to grow at only 13% or half of the pace of the S&P 500. So a lot of their earnings power was pulled forward due to COVID and the setups and the pull forward of all the Macs and things people had to buy to work from home and school from home, etc. So that's good. When the fundamentals back up the thesis and everything else. It's good to have those things in sync. Where to find income these days? This is a key study that I want to go through with you because a lot of you are saying, where am I going to get income? I need income. This is a really unique opportunity in history. And a hat tip to Dividend Growth Investor on Twitter, who published the historic information. But I want to tell you the story because a reporter asked me about finding income. And what I want to say about this is the opportunity here is selection for select income would be among mid to large cap, high quality dividend growers that have consistently increased their dividend over time. It is not only the yield you receive at the time of purchase that matters, but the pace and consistency at which they increase their dividend over time. So a great example is Warren Buffett from the late 80s to early 90s was buying up Coca-Cola. And at that point, split adjusted, it was trading at $3.25 a share. So the yield was 8.5 cents a share, which was basically a 2.6% yield at the time. What the average investor would do in that situation is they'd say 2.6% yield, it's already trading at 18 times earnings. Why would I buy it? The stock can fall much more than 2.6%, which is short-termism and the wrong mindset for this particular strategy. Because what would have happened is, so that measly 2.6% yield on Coca-Cola, they grew the dividend every single year since. Okay, so they're what they call a dividend aristocrat. And now that one share that was the basis split adjusted was $3.25. The dividend is $1.64. So you get a 50.4% yield on the initial basis of the stock, and he's paid no capital gains because he holds the stock. So it was a $1.3 billion investment. He gets about $650 million a year of income. Oh, and by the way, the stock has gone up 15x over the same period for a capital appreciation of almost $20 billion on top of the $650 million he gets in income. Now you say, well, yeah, if I had bought Coca-Cola in 1988, I'd be that rich too. No, because right now there are a tremendous number of stocks that are hugely off their recent highs due to COVID. This is an opportunity, which 1988, if you remember, was a 30-some-odd% quick correction in a secular bull market, which is what we just had, a 35% correction or 33 and change percent correction in a secular bull market. And the opportunities are there. And some of you, we covered 4 on Liz's show. Con Ed, Walgreens, Becton Dickinson, Campbell's. But, those, it doesn't have to be those. There are a couple dozen that are off their highs that have reasonable yields and have histories of growing their dividend, not for 5 years or 10 years or 15 years. Some of them have been growing the dividend every single year for 40 years. So you don't worry about what the stock does in the short term. You worry about, how fast a pace do they compound that dividend and that income, because 10 years, 15 years from now, you could be getting a 20, 30+% yield on your current day basis. Oh, and by the way, the stock will have probably appreciated 3, 4, 5 times in the interim, and that would just be whipped cream. The key is you're getting ongoing income that you can put into other businesses and stocks over that time. So right now, a bunch of them trading off their highs with reasonable yields and a history of growing the dividend over time. 3M, Chubb, Tootsie Roll, Black Hills, which is a utility, Cisco, that's the food service, Becton Dickinson, VF Corp, ADP, Coca-Cola, Con Edison, Walgreens Boots Alliance, ExxonMobil, Aflac, AT&T, International Fragrances, Tiffany's, Bristol-Myers, Pfizer, Hershey, HEI, Heiko, W.R. Berkley, that's an insurer, Travelers, General Dynamics, and Medtronic. So that's just a basket to do your own homework. See how they've compounded the dividend over time. See what their cash flow is, etc. But that's a good starting point. A handful of those, even if you're wrong on one of them, over time they're going to grow the income. So they're, again, not recommendations, do your own homework, but it just goes to show you what happens over time. That, people say 2.6% yield. That's not the story. The story is how is the yield going to compound? And we're at this historic time where you still have an opportunity to get these high quality franchises at big discounts. Oh, and by the way, Wells Fargo will reinstate the dividend at some point in the future. So that's the additional kicker on top of the appreciation that we're looking for. We're mostly focused on appreciation, but many people have been asking, where do I get income with rates so low? That's exactly where you get it. And you just tuck them away. And every year you get a pay raise. And that's a good thing. Okay, what about insurance? Another reporter asked me this week, what are you going to do to hedge against a potential crash in Q4? Opinion follows trend. That's what I learned at the first hedge fund I worked at. By the way, if you're listening to the podcast and we get cut off, just go to hedgefundtips.com. You can play the VideoCast. You fast forward to the 60-minute mark so you don't have to listen to anything twice unless you want to. And then you'll pick up the last 5 or 10 minutes that you missed, because we do have some important stuff to cover. So the quote that I gave her is, the time to buy insurance is before the house goes on fire. So we've had this pretty healthy correction in the month of September. Time to buy insurance was, 3 weeks ago when I was talking about Apple being overvalued and a rotation out of tech. As a matter of fact, there was an article that just came out. Wall Street's biggest 5 stocks by value are on track for their worst month ever. So that's Facebook, Amazon, Apple, Netflix, and Google. This is Mark DeCambry over at MarketWatch. So you can read that. And, that's for those of you who've been with me, you were ahead of the curve on that. Next, so she said, well, then what would you do if you're not worried about a big correction in Q4? I said, well, the seasonality for weakness is right now. This is the most seasonally weak period of the year, September, and particularly the week between Rosh Hashanah and Yom Kippur. Yom Kippur is Monday night, or Monday. And then they say sell Rosh Hashanah, buy Yom Kippur. We'll see if that holds. Maybe the market was front running that today. I could see potentially tech having a little bit more work to do to the downside, but let's see how it goes. I mean, there's been enough damage. I'm not focused on that anyway. I'm focused on those names that are going to benefit from the vaccine announcement, the reopening trade names. I'm not worried about the tech names, but so that's that. So what I would be doing is... Oh, okay. If you have some cash, now's a great time to be selectively picking up laggard stocks, financials, industrials, materials, small pockets of energy that will outperform in the early part of a new cycle. M2 money supply is up 20% since March. We filled a $1 trillion problem, GDP contraction. It's actually smaller than that now. It's like $750 billion contraction. With almost $10 trillion of authorized stimulus aid and liquidity, we didn't use the majority of that, which is why we've got the $400 billion on the sidelines ready for an executive order. And then I went into, tech outperforms when GDP growth is slow. Cyclicals outperform when GDP is fast. Why? Because managers have a greater supply of companies with fast earnings growth to choose from. Before they had to bid up a small supply of stocks where they could find earnings growth. That's changing rapidly. We're seeing it in the industrial numbers. We're seeing it in global economic data across the board. The economic surprise index is still at record highs. And you saw it starting with China, and now it's in the U.S. All the numbers, the PMIs, are just supporting cyclicals. So the vacuum, we're in an information vacuum. That's why you saw the choppiness. The market's thirsting for information on the vaccine, earnings, the election, and stimulus. Now, Ned Davis put out a chart that showed for the incumbent to win, for a Republican incumbent to win, this correction is normal, but you would see a reversal starting at the end of September into the election. So that's historic precedent. The data is from 1900 to 2016. Nothing's foolproof, but this is the compilation of all of those second-term presidents' election periods. And if you see this, so this will basically tell you what the likelihood is of the election. So if I'm in the administration and I see this dropping here, we're right here at this end of the third week of September. This is where it would have to inflect historically for it to point to the incumbent winning the party. And that's why I would be out there as the administration, number one, for the people who are left behind. Number two, if I want to win, to do the executive order and let them sue against me, because that's when I need the inflection and that's when I need things to turn around. So this is critical. On the flip side, if this persisted down after the third week, so this bounce was a fake out and then it rolled back over, the likelihood of re-election would be slim. And that would be a scenario where, they fuddle around over the stimulus. It doesn't get done. I don't think you'd see this necessarily if you don't get a stimulus. I think the market's priced in no stimulus, but you would definitely see this reversal if you did get a stimulus or an executive order, because no one's really expecting it at the moment. So it's nice that expectations are low, and this kind of tells you, so we'll see. This point right here, let's see. This point right here, this is when the administration did the last executive order in August. You see he was just falling off a cliff, and then he did the executive order, and he's narrowed the gap tremendously. This is the 2016 numbers. This is where he was in September. If you remember, he fell in the polls in October with the October surprise, and then he came back up in time for the election. Here he's just coming up again, so we'll see. But this is an opportunity to get money to a lot of people who have not recovered yet. So that's that. Interest rates, we just basically went through that with the survey. When you get the vaccine, you should see the 10-year yield start to go out. This is the 210 spread. This helps banks' net interest margin. It's in perfect sync with huge recoveries in financials, and we're starting to see it. And you get these little pullbacks, just like we had. You get these little pullbacks and fake outs on the way up, but the 210 spread is pretty wide, and no one's paying attention to that because they're just looking at low rates and the 10-year, but the spread between them is 5x. So between short rates and the 10-year, which is exactly what you want to see at the beginning of a recovery. The US dollar, I put out the commercial commitments of traders. Usually when you see commercials are the smart money, they start to buy in anticipation. So it looks like here that the dollar has bottomed in the short term, and that's playing out based on that. The speculators and large traders and hedge funds are now net short after the fact. They're late to the party, and that's why you're seeing this reversal. Sentiment was all mid-range this week. I mean, the AAII did get to the low 20s again, which is historically buy versus sell. That's the only one that got to an extreme. Fear and greed was at 46. That's mid-range. And the active managers got washed out last week. They started to buy a little bit this week. So our message was that don't bet against science. That's been our theme. When you get that announcement, we're going to see that catalyst into cyclicals. Some of the sectors that are already seeing the orders, like industrials, materials, transport, and financials to a lesser extent, are outperforming tech. Once you get the announcement, yields will blow out, financials will follow, and I did mention, and we got it the next day, that the pain trade is likely a little bit lower for some of the over-owned names. We'll see. I still am kind of that camp. When you have such a quick thing, people want it to be over. They want to believe it's over. You get these technical bounces. We'll see. But it doesn't necessarily, even if those over-owned names stay a little weak for a few more weeks, it doesn't mean the indices have to continue to get pummeled despite the weights, because I think there could be enough of a bid in some of the heavier weighted cyclical sectors to pick up that slack. And that's going to be, we're going to find out if there's a catalyst. Is there an executive order? Is there a deal to be done with Congress? And I think or is there a vaccine announcement? I mean, we just continue to get surprisingly better data. And, if you want to know how the leg sweep ends, I would just take a look at this. Brings back a lot of memories. You got the leg sweep down to the mat, here he is. He goes into his crane pose. And all of a sudden, this is what happens. And it's over. So hopefully that will be the Wells Fargo Bulls Day in the sun. And Mr. Miyagi will be happy that we were patient. So moving on, these are some of the institutional prints that came in on Wells Fargo calls this week. 5,200 contracts, 6,200 contracts. There were more today. I didn't want to put any more out. Also, Boeing and Raytheon, we've been talking because home builders had already had a run. We were pitching those in March and April. They'll continue, by the way. That's going to be a secular trend with the millennials. 85 million millennials starting housing formation, accelerated by COVID. But what we were talking about was laggards. We like banks, defense stocks, and some pockets of energy. Well, Goldman upgraded Boeing and Raytheon to key defense stocks this week. Boeing started to move today on 737 certification flights, I think starting next week. And Raytheon, it's nice to see a defense stock. So the climate is changing. People are starting to look at valuations and wanting to know what they own, because growth is going to come, and you're going to have more choices where you can buy earnings growth. The other thing is COVID is growing less deadly as doctors gain practice and the drugs improve. They point out Gilead's remdesivir, the steroids, and most importantly, which we talked about 3 months ago, I was telling you what our friends that are concierge doctors are doing. Well, one, they were giving ivermectin, which, that's very controversial, so ignore that part. I have it in my house. But, and also blood thinners. Blood thinners is a key factor. So now they're doing that in the hospital, because that's what was causing a lot of the deaths, is the clotting, not as much the illness. So if you can just have the blood thinners till you can recover from go on your stomach, the steroids for the breathing. So a lot less people are dying, even if the cases spike up, and the cases are also becoming less severe from what they're reporting. But the other thing is, this week, there were trial site reports. TrialSiteNews.com is a really valuable thing because they monitor all these different drug trials. And they reported positive momentum for Regeneron's monoclonal antibody treatment, along with Lilly's monoclonal antibody treatment. So you can read that. I posted it in one of our reads, or you can just go to Trial Site News and it comes right up under popular posts. And that's key, because treatments, I think, are as important, if not more, than the vaccine, because that'll give people latitude to go out and we could potentially get it. But what they said here, Trial Site has reported that Lilly's monoclonal antibody evidenced promise at a trial site location in southern Texas, and that shortly thereafter, recent interim analysis data from Lilly backed that observation. Now Regeneron's monoclonal antibody cocktail designed to take on COVID-19 apparently yields positive results in San Antonio, Texas, as well as a local trial site operation called Sun Research Institute. One of about 150 such sites globally reports on positive observations to local press. Reports of progress are so promising that local media suggests the therapy could be available in weeks. Probably not possible, but the progress here is worth noting in the trial site. So you can read that for more details. That would be really great to see that, to have the remdesivir from Gilead, to have these monoclonal antibodies, and just give people more confidence that they could go out and get back to business. Keep wearing your mask until we have the vaccines. But, Johnson & Johnson got this one-shot vaccine into phase 3 this week. That's huge. Pfizer's on track to be the first to find out if the COVID vaccine works. So they're now the front runners. As far as the market goes, Urban Carmel put out a post today that I thought was helpful. What does the S&P do after being down 4 weeks in a row? Since January 2009, 7 out of 8 closed up in the next week, which would be consistent with Sel Rosh Hashanah by Yom Kippur. 2011 was the sole exception, but it rallied shortly thereafter. In the last 20 years, most of the further declines happened when the S&P was under its 200-day moving average. The S&P is above its 200-day moving average, as you can see here, so that would not apply. And this just shows those instances. So after 4 weeks of down, you got the up. 4 weeks of down, you got the up. 4 weeks of down, that was a failure, but you got the rally after. 4 weeks of down, you got the up. 4 weeks of down, you got the up. 4 weeks of down, you got the up. And 4 weeks of down, you got the up. 4 weeks of down, you got the up. Okay, so you get the point. Okay, so that's promising. Some high-frequency data. Chase Consumer Card Spending Tracker this week out by Sam Rowe. That's getting to pre-pandemic levels. That's really good. Bank of America Truckload Diffusion Indicator for U.S. shippers. 0 to 3 month freight demand outlook jumped to 71.1, the highest level since July of 2018, pre-pandemic levels. Very exciting. Pace of new home sales tops 1 million for the first time in 14 years. That's out of control. Exciting. And some economic data for the week. We had, okay, let's look at existing home sales were 6 million. That was ahead of 5.86 last month, up 2.4%. Richmond manufacturing came in at 21. That was beat. On Wednesday, okay, the housing price index prices were up 6.5%. Mortgage MBA purchase index was up. Mortgage applications was up 6.8% week on week. And by the way, when mortgage rates start to tick up, which they did, by the way, this week from 3.07 to 3.10, that's when people really start running, and you see a huge acceleration in demand, and things really start to hit because people get fear of loss. Manufacturing PMI, huge beat, 53.5. That's an expansion, up from 53.1. Services PMI was in line, a little bit light, but the combined was okay. We had a draw of 1.6 million barrels, negative 2 million barrels expectations, negative 4, but it was still negative. This is still in line with what we said in June, that we were going to move from builds to draws. We've continued to do that every single week. And, no one sees it. We're gonna wake up, we're going to see $60 oil sometime in the next 12 months. And people are going to say, what happened? Look back at the Rystad chart that we posted in the end of June relative to the ongoing OPEC cuts and control of the market. So that's good news. Continuing claims came down from the last print. That's the most important number. Initial was up a little bit, but that's noisy. We had the reopenings and closings and that kind of stuff. So that was that. New home sales up 4.8%, over 1 million sales. Again, that was the highest in whatever it was, 14 years or something like that. So that was really exciting to see. And then durable goods orders were down a little bit. But goods orders non-defense were up, so that's good. And the rig count actually ticked up a few rigs, four rigs on the oil and 6 total. So that's interesting. That's interesting. And then China industrial profit was up 19% today, so for year on year. So that's going to trickle there. Again, 2 to 3 months ahead, we're going to start to see these numbers the back half of the year. Future's bright. Thanks for tuning in. We'll be back next week, same time, same place. Hope you found that helpful, and make it a great one. Bye-bye.